Hi CA students, let's revise CA Final AFM, Chapter 8 Mutual Funds, Practical Question 17. A mutual fund company introduces two schemes, that is Dividend Plan Plan D and Bonus Plan Plan B. The face value of the unit is Rs 10. On 1/4/2005, Mr. K invested 2 lakh each in Plan D and Plan B when the NAV was 38.2 and 35.6 respectively. Both the plans matured on 31/3/2010. Particulars of dividend and bonus declared over the period are as follows. So it is the same as previous question, but here the assumptions of the long-term capital gain and short-term capital gain and then XTT tax is not given. Hence, we can proceed. So we have the date of investment being 1/4/2005, and they told that the maturity period ends on 31/3/2010. So the period of holding is 5 years in both the schemes. And as they have told, two schemes, Plan D is dividend plan and bonus plan. Um yeah, dividend plan and bonus plan, and dividend percentage is given, bonus is given, net asset value on the respective dates are given. Let's go with the first plan, Plan D. So Mr. K invested on 1/4/2005, invested 2 lakh in each plan, they told, and on the date of investment the NAV is 38.2 and 35.6. So 2 lakh divided by 38.2 will give us the units acquired, total units acquired, which is nothing but 5235, which is on 1/4/2005. Now in case of dividend plan, the dividend will get reinvested. That is the assumption here. So okay, first dividend issued was on 30/9/2005 and amounting to 10%. On that date NAV is 39.1, so it will be reinvested in this NAV value 39.1. As we can see, the units held is 5235, and units face value is given as Rs 10. Hence this 5235.60 multiplied by 10 will give us the dividend amount, no, into 10 on the 10% will give us the dividend amount 5235.60, and dividing it by the NAV as on that date 39.1 will give us the new units to be reinvested. So new units being 133.9 will get added to the balance units, which is nothing but 5235. So the added so the closing balance as on 39/2005 is 5369.50. Then the next dividend is issued on 31/3/2007. So 15% issued 31/3/2007, and the balance unit is 5369.50 multiplied by 10 multiplied by 15% will give us 8054.25, and the date as on the dividend the NAV as on dividend issued is 44.2. So 8054.5 divided by 44.20 will give us the new units to be reinvested, which is nothing but 182. Again this will get added to the balance units, and then the balance becomes 5551.72. The same way, whenever a dividend issued, we have to take those dates. So the next two dates are 15th and 27th. Same here is considered in the solution. And the balance as on 27/3/2009, because that is the last day the dividend was issued, so the balance is to 5915.92. And after an year, on 31/3/2010, the plans got matured, so plan D will get matured in 31/3/2010. As on that date, if we see, plan D's NAV is 40.4, so the balance units available is 5915.92 multiplied by this 40.4 will give us the maturity value, which is nothing but 2,39,003.17. Now In this we will be reducing cost of acquisition. In the previous problem, as the assumptions they've given for tax and then short term tax and then the STT, from the value of from the redemption value, these are reduced and then the net of tax is found out. On that investment we reduced to get the net return. In the current problem, there is no tax or any assumptions are given, hence whatever redemption value we got minus the cost of investment will give us the total gain or the total return earned from the mutual fund. So in our case it is 39,003.17, dividing it by the investment 2 lakh, and then as we notice it is for the period of 5 years, right? So the return what we earned is also for 5 years. So dividing it by 5 and multiplying it with 1 will give us the yearly effective yield. Because they have asked effective yield per annum, hence we need for 1 year, which is nothing but 3.90 in the case of plan B. Same way goes with plan B. Plan B is about bonus issues. So in the case, bonus was issued on these dates: 30/6/2006, and then 30/10/2008, and then 11/4/2009. So these 3 dates has to be considered. On 145 investment is 2 lakh. In the case of bonus issue, 35.60 is the NAV value. So 2 lakh divided by 35.60 will give us the number of units as on that date. After that, the first bonus happened on 36/2006. So on that, 1:5 is the ratio. The balance units is 5,617.98, which is nothing but the opening units, divided by 5 multiplied by 1. So that will be the new units to be added, which is 1,123.6. So adding both will give us the balance units as 6,741.58. Now the next bonus was issued on 30/10/2008, which is in the ratio of 1:8. So whatever the balance units divided by 8 into 1 will give us the new units, which is nothing but 842.7, and the NAV as on that date is 38.8. And then the next bonus was issued on 11/4/2009. The balance units is 7,584, which is in the ratio of 1:10. So divided by 10 multiplied by 1 is 758.43. Adding it up, the closing mutual fund balances amount to 8,342.71, and the NAV as on the last day when the mutual fund got matured is 39.70. Hence 8,342.71 multiplied by 39.7 will give us the maturity value, and then the investment is 2 lakh. Hence if we reduce that, we will get the gain or the return from the mutual fund on the bonus plan, which is plan B, which is nothing but 1,31,205.59, divided by 2 lakh is the investment. And as we told previously, this is for 5 years period, we need it for only 1 year. So divided by 5 multiplied by 1 will give us the 1 year return, so which is nothing but 13.12. And as we can compare, the dividend plan, which is plan D, gave us only 3.90, but the bonus plan has given 13% interest yearly. That's it. Thank you.